90% of investors lose money because they're trapped in a system designed to feed their impulses. The wealthy, they play a different game entirely. Let me show you the first pillar of their strategy. Something so counterintuitive you've likely never heard it framed this way. Most people believe diversification is about spreading money across stocks, bonds, and cash. That's a myth. Billionaires structure their portfolios into 3 invisible tiers. The first tier isn't stocks or real estate. These are assets that print money on autopilot. Silent partnerships in private companies, royalties from intellectual property, or even niche subscription services. They don't chase dividends. They create cash rivers. Second tier is where the magic happens. Asymmetric bets. These are investments where the downside is capped, but the upside is exponential. Think litigation financing, where you fund a lawsuit in exchange for a percentage of the settlement. If the case loses, you lose a fixed amount. If it wins, you could make 20 times your money. Or consider pre-IPO shares in companies backed by sovereign wealth funds. The elite don't buy what's trendy. They infiltrate markets where information is scarce and margins are grotesque. The third tier is decay-resistant assets. Most investors panic during crashes because their portfolios are full of depreciating paper. The wealthy hold physical assets that gain value when systems fail. Agricultural land with water rights, rare earth mineral rights, or even vintage aerospace components. These aren't glamorous, but they're bulletproof. Here's where 99% fail. Emotional weighting. People pour money into what's surging. Stocks, crypto, then sell when fear peaks. The elite use mathematical coldness. They allocate specific percentages to each tier and rebalance ruthlessly. If asymmetric bets spike, they take profits and funnel them back into cash engines. If decay-resistant assets dip, they buy more. No emotion, just calculus. You're probably thinking, how do I even access these opportunities? That's the trap. Mainstream platforms won't show you pre-IPO deals or litigation markets. Or, as you'll see in our next section, you need to exploit loopholes that turn the system inside out. But first, ask yourself, is your portfolio built to survive or designed to conquer? The wealthy don't just break rules, they rewrite them. While most see a painting, billionaires see a tax-shielded asset that appreciates in darkness. But art is just the tip of the iceberg. Let's dive into the second pillar, non-linear opportunities. These are investments that defy traditional growth curves, where returns don't climb steadily. They explode. Imagine a tech startup's pre-IPO shares growing 20 times overnight. That's child's play compared to what happens in shadow markets. Consider securitized royalties. Musicians, inventors, and even athletes sell future income streams to investors. If a song goes viral or a patent gets licensed globally, those royalties compound like a hidden avalanche. One investor turned $50,000 into $2 million in 3 years by buying royalty streams from a then unknown indie artist. The key? Access to private exchanges where these deals flow. Then there's farmland, not the dirt you're picturing. Specific plots with water rights in drought-prone regions. As climate patterns shift, these become geopolitical gold. Billionaires buy through opaque trusts, turning scarcity into profit while others fight over shrinking resources. But here's the twist. The ultra-rich avoid public markets for these plays. They use private syndicates, family offices, and invitation-only platforms. Ever heard of litigation financing? It's where you fund a lawsuit in exchange for a cut of the settlement. One fund delivered 400% returns by backing plaintiffs in corporate whistleblower cases. Why don't financial advisors mention this? Because they're incentivized to sell you mainstream product. The elite's real edge isn't wealth, it's intel. They infiltrate networks where deals are whispered, not advertised. For example, certain hedge funds allocate up to 30% of their portfolios to special situations, distressed debt, embargoed goods, even cryptocurrency arbitrage in banned markets. You're thinking, this sounds illegal. It's not. It's simply structured through layers of LCs and offshore entities. The game isn't about breaking laws, it's about bending frameworks. While retail investors buy ETFs, billionaires acquire entire forests in developing nations, generate credits, and sell them to polluters at 10 times the initial cost. The pattern: identify systems where value is misunderstood, leverage asymmetry, and exit before the crowd arrives. But how do you spot these opportunities without insider access? That's where the third pillar comes in. A legal tax hack so potent, governments quietly encourage it. They use structures so mundane, governments openly endorse them. Take charitable remainder trusts. You transfer assets into a trust, claim a deduction for the charitable portion, then receive income from the trust for years. At the end, the remaining assets go to a charity you control. One tech founder reduced his tax bill by 80% while keeping cash flow intact. But the real magic happens with opportunity zones. Invest capital gains into designated zones, defer taxes for a decade, and if held for 10 years, all appreciation becomes tax-free. Developers buy crumbling warehouses in these zones, convert them into data centers, and exit with zero taxes on millions. The trick: the zones aren't just in inner cities. Some cover prime waterfront areas disguised as distressed. And there's the family office loophole. Ultra-wealthy families pool assets under a single entity classified as a business. This lets them deduct personal expenses, jets, security, even vacations, as operational. One family office saved $12 million a year by reclassifying a yacht as a client entertainment vessel. The most potent tool: captive insurance companies. Businesses create their own insurers to cover niche risks, cyber attacks, supply chain failures. Premiums paid to the captive are tax deductible. One billionaire built a $500 million portfolio this way, shielded from both taxes and market swings. You're wondering, why doesn't everyone do this? Because it requires upfront capital most don't have. Structures like these aren't secret. They're buried in tax code subsection 730-8. The wealthy hire attorneys to weaponize these clauses, while the public dismisses them as loopholes. Here's the kicker: governments allow this. Why? Because these tools stimulate targeted investments. When billionaires pour money into opportunity zones, politicians get photo ops at new hospitals. Everyone wins, except those stuck paying full freight. But the ultimate tax hack isn't about saving. It's about resetting timelines. Which brings us to Pillar 4, how the rich manipulate time itself to make compounding their slave. Time is the billionaire's most merciless ally. While others chase compounding through decades of patience, the elite engineer timelines. The fourth pillar is temporal arbitrage, manipulating when money moves to hijack growth. Here's how it works. Most investors buy and hold, hoping time alone will multiply their assets. The wealthy layer their investments across staggered timelines. They call it laddered liquidity. Imagine having portions of your portfolio maturing every 6 months, not years. When markets crash, they have cash ready to deploy at the bottom. When markets peak, they harvest gains on autopilot. Take certificates of deposit. The wealthy use brokered CDs, buying hundreds of short-term ones, creating a rolling cash cascade. If rates rise, they reinvest immediately. If rates fall, they pivot to private credit. This isn't passive, it's a liquidity assembly line. But the real power lies in duration matching. Billionaires align investments with predictable macroeconomic cycles. For example, buying 7-year municipal bonds ahead of infrastructure bills, or 10-year energy futures timed to grid upgrades. They don't guess. They sync with legislative calendars. One family office doubled its wealth by buying lithium rights before EV subsidies passed, then exiting as laws took effect. The deadliest tool: staggered option chains. While retail traders gamble on weekly calls, the elite sell multi-year put options on assets they own. This generates upfront cash while maintaining upside. If the asset appreciates, they keep it. If it crashes, they buy more at a discount. It's a win-win loop only available to those with collateral. Here's the brutal truth: compounding isn't about time. The average investor's returns are gutted by 3 things: panic selling, missed entry points, and opportunity cost. The wealthy automate these decisions. They set algorithms to buy when fear indices spike, sell when greed dominates, and reallocate during low-volume windows. You've heard buy low, sell high, the elite version. Buy when others can't, sell when others want. During the 2020 crash, certain hedge funds had clauses to borrow billions at midnight rates, scooping up assets while retail investors slept. The last pillar reveals how billionaires hack their own psychology to avoid fatal mistakes, because no algorithm can save you from self-sabotage. The final pillar isn't about money, it's about rewiring your brain. Billionaires don't just outsmart markets, they hack their own psychology to avoid the traps that destroy 99% of investors. Let's dissect the 5th pillar: neurological dominance. The wealthy aren't immune to fear or greed. They build systems to override it. Start with pre-commitment strategies. Retail investors make decisions in the heat of a market crash. The elite pre-program their moves. They set binding contracts with their investment committees. If an asset drops by 20%, they automatically buy more. If it triples, they sell half. No debates, no panic. Then there's the blind trust paradox. Billionaires lock portions of their wealth in trusts managed by third parties with strict mandates. They literally can't access the money until conditions are met, like a 10-year hold period. This eliminates the temptation to cash out early. One hedge fund founder grew his net worth tenfold by locking 80% of his capital in a trust that only invested in 30-year infrastructure bonds. But the ultimate weapon is negative reinforcement. The wealthy hire behavioral coaches who charge penalties for irrational decisions. Miss a rebalancing window? That's a $100,000 fine to your charity of choice. Sell an asset during a dip? Another penalty. They turn discipline into a financial necessity. Here's the brutal reality. Your biggest portfolio risk isn't the market. It's your amygdala. The brain's fear center hijacks logic during volatility. Billionaires counter this with cognitive pre-mortems. Before investing, they visualize catastrophic scenarios, markets collapsing 50%, inflation spiking, and pre-write their responses. When crises hit, they follow the script. Take the 20 pandemic crash. Most sold in terror. The elite activated preset buy orders for blue-chip stocks at fire sale prices. They didn't predict the bottom. They prepared for it. Yet the most critical hack is scarcity inoculation. The wealthy simulate poverty. One billionaire allocates 5% of his net worth to a separate account he calls the gutter fund. Each quarter, he must survive on that amount alone. This keeps him grounded in reality and allergic to reckless risk. You don't need millions to start thinking this way. Begin with a one-page investment constitution. Write down 3 non-negotiable rules. Automate them. Penalize yourself for violations. The goal isn't to mimic their portfolios. It's to adopt their mental architecture. The 10 billionaire secrets. This is how the game is played at the highest level. The question is, will you keep spectating or rewrite your rules?